Happy Friday, everybody. What does a steepening yield curve mean for stocks? My name is Kurt Mueller, and that's what we are diving in today. Why are we chatting about this? We're chatting about this because yesterday, the 10-year T-note, Treasury note, topped 1.15%, and that's the second time this year already. So really less than 6 weeks into 2021, it has topped that mark. And it's primarily due to two main things. So we've got one, firming inflation outlook and expectations of a stimulus driven surge in the national debt and deficit. So again, those are two main factors there that are really driving up the 10-year yield, and that is the stimulus driven surge in the amount of national debt and deficit this country is going to go into to get this 1.5 trillion-ish bill put into place. And then secondly, as I mentioned, it's really these firming inflation expectations. So again, why is this a big deal? It's a big deal because that 10-2 spread, right? The spread between the 10-year Treasury note and the 2-year Treasury note has widened to 103 basis points, which is a post-COVID high. So that's significant because the 2-year rates right now are effectively near zero based on an extremely dovish Fed that we have, who has effectively said they're going to give us an open checkbook to continue to support the economic recovery. And so by and large, this steepening of that curve is due to the rise in 10-year yields. And that is what a lot of market analysts and experts like to call a bear steepening. So what exactly does a bear steepening tell us? Well, number one, it tells us that inflation expectations are higher. That's the first thing it tells us. And secondly, it tells us that economic growth outlook is really good. And so historically, both of those are a good sign for the stock market in the near term. But here's the issue I think we should all be aware of. It also serves as a warning sign that the clock is ticking, and the clock is ticking on the Fed, because if we start to get an overheated economy, then the Fed may not remain, or historically will not remain, as easy on their money policy, because they want to do whatever they can to tighten those financial controls to combat, runaway inflation. And the best way to think about runaway inflation and why that could be a problem is, I'll use this analogy of a fryer. If you're frying food, there is that happy medium to where you don't want to get the food, you don't want to leave the food in the fryer too long, but you also want to leave it in there long enough. And so we all know what happens if you leave food in the fryer for too long. It's overcooked, doesn't taste very good. And that's exactly what could happen with an overheated economy and runaway inflation. And so the clock is ticking, as I said, because now it's just simply going to be a matter of when the Fed starts reining in those controls and tightening their policy to prevent and combat runaway inflation. So I think the bottom line here is this. I think it's really important that we pay attention to the movement in the 10-year Treasury note. And the reason I say that is this. It's often said that with a bull stock market, it typically will be an escalator up, but an elevator down relative to a bear market, right? So it creeps up and then it just comes crashing down. When we talk about the widening of a yield curve and what the impact that could have on inflation and asset prices such as equities, that is more like a elevator up and then a escalator down. So it's almost an exact opposite of what a bull market typically looks like, just from a trend standpoint. And so I think it's really critical that we pay attention to what's going on with that 10-year yield, because that's going to tell us, again, that's going to serve as a warning sign as to when we might expect the Fed to change its stance in preparation to combat an overheated economy. And again, the analogy that I used is to think of a food fryer when it comes to an overheated economy. You don't want the economy to get too hot, because we run the risk of having runaway inflation. And you can ask anybody that lived through the 70s what that looks like. So all things being equal, I think it's a certainly positive for near term, right? So it's definitely a positive outlook near term for equities. But my concern is, again, this steepening, this bear steepening of the yield curve and the pressure that's going to mount and start to put on the Fed to take a hard look at their accommodative policies and potentially even start reining the economy back in, which of course will be, in my opinion, the telltale sign that it's the beginning of the end for this stock rally that we've seen as of late. So keep your eyes and ears open, I would say. And again, pay attention to what's going on with the 10-year yield and how that's impacting markets and the economic recovery. As always, if you have any questions, comments, please feel free to drop them below. Happy to answer them and appreciate you watching. Have an awesome weekend. Keep doing great things and keep dominating. Take care.